Hello everyone and welcome. Let's focus in on the data that's flashing in on your screen. And you've got the CPI figure standing well above what the street was anticipating for the month of January at 7.59%. This is versus the ET Now estimates of about 7.3%. The IIP number is not spelling a good picture either. In fact, this time around, while we were going in with expectations of a growth of 1.7%, there has been a degrowth at about 0.3% for the numbers for the IIP for the month of December. So all in all, it looks like a fairly bleak state of affairs when it comes to the overall macro picture. Joining me right now is our consulting editor, Mythili Bhusnurmath. And for the discussion, there's Saugata Bhattacharya, Chief Economist at Axis Bank, as well as Madan Sabnavis of Care Ratings, and Akhil Mittal, Senior Fund Manager, Fixed Income at Tata AMC. Mythili, I'm going to hand it over to you because it's looking like a fairly bleak picture.
Well, yes, but I'm not very surprised on the CPI because though the polls were suggesting about 7.4, between 7.4 and 7.6, it is not very much more. Moreover, this is driven largely by food articles, and the expectation is, and rightly so, that this is a temporary phenomenon which will come down. I would be more worried about the IIP because IIP had turned positive in November after 3 months of negative, after 3 months of contraction. So once again, to have it showing a contraction, albeit 0.3%, is very discouraging, particularly because this comes so soon after the finance minister spoke about the 7 green shoots. So clearly the green shoots are still not here and we'll have to keep waiting for it for God knows how long. But let me just now to turn to Madan and ask him the same question. Madan, are you more disheartened by the industrial production data than by the CPI data, or are you equally distressed by both? Madan?
No, in fact, in terms of IIP, we were expecting a positive growth rate. In fact, we had something like 2.6%. That's what our model showed. And this was based also on the fact that the low base effect would help to push up the number. But now that it comes in a negative number, I think what you are saying, Mythili, is perfectly right. It actually goes against what the FM has been talking about in terms of green shoots. And given the fact that even for January, we have seen that auto sales have been negative, I don't think there's going to be there are any signs that there could be a revival in the IIP growth in the remaining quarter, and it's going to be a very, very low number for the entire year. In terms of CPI, I think we had a number of 7.5%, so it's more or less on target. And I think the concern is not just the food products, which would probably start moving downwards, the inflation for those numbers. But I think even in terms of the core inflation numbers, I think that should be moving in the upward direction. We have seen things like telecom, freight rates moving upwards. So I don't think there's going to be much relief on that side too.
Akhil, your first reactions? Because even though Madan agrees with me partially, he feels that on CPI also we really cannot afford to relax our vigil. Whereas I'm a little bit more upbeat on CPI. Akhil?
So yeah, CPI is hovering much higher than the normal numbers. We had expected around 7.30 kind of a number, but looks like veggie inflation is not coming down in a hurry. Well, we all know it is going to over a period of time come down, but there are chances and probabilities that these high food inflation numbers start feeding into generalized inflation over a period. So that is the only fear that we have at this point in time, that in case this lasts a little bit longer than what we anticipated, then this might start feeding into generalized. And on the core side, again, core is already last 2 prints we have seen is inching up slightly. I'm yet to see the numbers over here, but seems like the core would have also gone up a bit. So a core moving upwards and veggie inflation leading to food inflation going up is not that great a scenario, and IIP numbers coming down just increases the complexity of the situation. Green shoots of growth, as you said, as what we were talking generally, seems like they were more of a temporary one-off phenomena. So CPI higher, IIP lower, it's just not a good scene to be as of now.
We wait for the disaggregated numbers of IIP because I really would be interested in knowing what was manufacturing output in December. Mother, let me ask you a question which I think has been worrying me. That even though I'm not really distressed about the CPI higher number, what does worry me is the kind of flush of liquidity that the RBI has unleashed on the market. As it is, you had large surplus liquidity with the RBI absorbing more than 3 lakh crores. And now we have the RBI doing long-term repos, encouraging more forex flows. Is there a danger that all this surplus liquidity will build up into asset bubbles and somehow will spill over into inflation? So inflation may not be the temporary phenomenon that I'm hoping it will be, and there is this danger of surplus liquidity feeding into inflation. Madan, Awan, meanwhile, can we have the breakup of the IIP for December?
No.
Please, Madan, carry on.
See, in terms of the surplus liquidity which you're talking of, I don't think. Okay. Now, should I reply, Mythili, or you're getting the
No, please carry on.
disaggregated numbers? Yeah. See, in terms of the surplus liquidity, I don't think there is much fear of that becoming inflationary. Because today, if we're looking at the overall phenomenon of inflation, I think it's more on account of the supply side factors which have pushed up inflation. Some have been done institutionally, like if I'm talking of those components of core inflation, it's more because of institutional factors rather than excess demand forces which have been unleashed. So therefore, I think most of this excess liquidity which is there is going to be beneficial for the government in particular. So in terms of the markets and as to whether government borrowing is going to come into way, presently does not look to be any kind of a visible threat. Now, whether it's going to lead to asset bubbles, to my mind, not. That won't happen. Because if you look at the entire system of finance, which is being done by your banks or even your NBFCs, I think they're doubly cautious when it comes to lending. So I don't think it's going to lead to an asset bubble. But definitely, I think the main focus of our policymakers so far has been to tackle a demand side problem with supply side responses. So that's one of the reasons I think there has been this kind of a mismatch between the two, and we're seeing that despite notwithstanding what the government is doing in terms of policies, what the RBI is doing in terms of interest rates, in terms of liquidity, it's not really helping, because I think we have reached this low equilibrium trap, maybe a kind of a liquidity trap in which you had during the times of the depression, where nothing on the monetary side really works. And I think what's really required is something on the demand side, which is going to pick up only in gradual course of time, because the budget has not provided for anything exceptional. A fair enough thing, given the fact that we have the FRBM rules which make sure that the government should not be going in for excessive spending. But I think the result is that things are going to take a very long time before we pick up, and that's exactly what the IIP numbers show.
All right, stay on with us. Lots more to dissect by way of the quarterly, by way of the December and January data. And I'm just going to flag off all of the latest numbers that are trickling in as we speak. Now, for the month of January, as we said, the core inflation stands at about, the core CPI inflation stands at 7.59. The Jan core inflation at 4.2% versus 3.8% in December. So there has definitely been that rise. The food inflation as well, that's been a slightly lower tick, 13.63% versus 14.12% in the month of December. The CPI fuel and light inflation stands significantly higher at about 3.66% versus 0.7% in the month of December, with the urban inflation standing a little bit flat, 7.39% versus 7.46% in the month of December. The CPI rural inflation figure, that is a little bit higher at 7.73% versus 7.26%. Mythili, that's a lot of numbers that I've just thrown at you. The food price inflation, just wanted to get a commentary on that, because that has been a concern. There's been a bit of a downtick at 13.63%. How are you looking at the number as well as some of the other breakdowns?
Well, as far as inflation is concerned, I continue to hold the belief that this is going to be a temporary phenomenon. It will take 2 or 3 months, but I'm not excessively worried about food inflation. Also about the overall headline inflation. What does worry me is the uptick in fuel. So if fuel prices, because oil is always a big question mark, one really doesn't know which way global tension will suddenly see oil prices shoot up. So oil is always one big imponderable that we have in the Indian context, but I would still worry less about inflation than about the decline in the IIP. But we know, joined now by Saugata Bhattacharya, Chief Economist of Axis Bank. So Saugata, do you share my view that it is IIP that is more worrisome than inflation? Inflation will trend down, provided, and I repeat, provided the surplus liquidity that RBI has unleashed on the market, something that Madan believes that actually monetary policy can be written off. But it's not going to make any difference, in which case it shouldn't affect inflation either. But I still worry a little bit about inflation, but worry more about factory output. Do you?
I agree with you, Mythili, that I mean this print of negative whatever print is certainly much lower than our own expectation of about 1.6% that we had expected for the IIP growth. So this is definitely a much worse shock. although the inflation print is also on the one side higher than what we had expected. My only worry about inflation at this point in time, because with this print that has just come in, the entire trajectory of inflation, so even if the inflation rate falls sharply with food prices and the others, inflation is likely to come down, but it's still likely to be very close, just above or very close to that 6% upper band. So whether one likes it or not, my sense is that it will be very, very difficult for the MPC to try to move the rates. But that's okay, because as the last review meeting showed, that even they probably recognize that the scope and potential utility of cutting the repo rate is limited at this point in time. So the focus has been on transmission, on incentivizing credit, etc., which is actually good given the numbers that we are seeing on the IIP. So this sort of is a fairly, although December is still just the beginning of the green shoots, and we do expect some improvement in January, but the negative number for IIP for December actually makes us reevaluate the assumptions that we have on small modest recoveries that we were expecting in January and February. And I still need to see the breakups of the individual segments, but I agree with you that the growth number is quite worrying.
Oh yeah, and as Mythili was talking about, a little bit disconcerting when it comes to that fuel inflation number as well at 3.6% versus 0.7% in December. Let's focus on IIP for a moment as well, and that contraction as well is glaring at 0.3% a negative versus our estimates of about 1.7%. That of course is the headline number, but we have more details as well. The mining output stands at 5.4% versus 1.7% in the month of November. You've got the December primary goods output at 2.2% versus a negative 0.3%. The capital goods output as well, that has come in at a negative 18.2%. Remember, we have been seeing a contraction here because even in the month of November, it was a negative 8.6%, but now in double digits. The intermediate growth output, well, that has come in a little bit lower, 12.5% versus 17.1% in November. Consumer durables output, here again a major decline, minus 6.7% versus minus 1.5%. And you've got the consumer non-durables output as well that has seen a contraction to the tune of 3.7% versus 2%. I also have with me the electricity production for the month of December, and that has come in at minus 0.1% versus a minus 5% in the month of November. Mythili, among the lot, what do you think really stands out in terms of the overall slowdown that has led to the headline number as well contracting for IIP?
Well, I think Awan, in the list that you gave us, manufacturing was missing. So I'd like to know what the manufacturing growth was. So we have that number, maybe we will put the puzzle together, the jigsaw puzzle together. But certainly the fact that there's been such a sharp decline in capital goods is very worrisome. But the fact is that the decline in gross fixed capital formation has been one of the biggest contributors to the slowdown in growth. And though the government has said it will continue spending and it will ensure that investment takes precedence over consumption, the fact is that until the private sector comes in, you're not going to see an improvement in gross capital formation. So I think, Madan, would you agree with me that this decline in gross capital formation, fixed capital formation, is perhaps one of the biggest worries, and government alone cannot shore it up? Would you agree, Madan, with that?
No, I would absolutely agree with you there, because I think investment is actually the job of the private sector. The government can only supplement in a limited manner depending upon the amount of fiscal space which is available. So while the government has done a very good job in terms of making higher allocations, sticking to what was done in the 1920 budget, allocating higher funds in 2021, but finally it has to be the private sector. And as you've rightly mentioned, if you're talking of capital goods showing repeatedly a negative growth number, it just means that investment is not taking place. And I think the RBI had also mentioned that the average capacity utilization rate has actually come down to 70%. So we are really talking of 78-80% being the ideal number before fresh investment takes place. We're talking of a banking sector which is reluctant to lend for infrastructure purposes. We don't have too many private investment projects which are online. So therefore there is going to be stagnation in terms of industrial growth and overall GDP growth. So even today when we're talking of moving from 5 to 6% in 2021, it's going to be a very gradual kind of a movement, aided also by the base effect. That's a statistical effect. I don't really see too many great things happening in 2021 as of now, based on whatever we know.
All right, and the missing link or the missing piece in the puzzle, Mythili, the December manufacturing sector growth, it has been quite disappointing. A contraction of 1.2% versus 2.7% growth in the month of November. So this perhaps to a great extent as well also explains the kind of headline figure that we're seeing for IIP.
Oh, absolutely, Aman. You brought in the missing link because in the manufacturing accounts for almost 70% of the IIP. So when manufacturing declines so sharply, it is inevitable that the overall general number will also decline. And this is particularly worrisome, not just because of the decline in the headline number, but manufacturing is where the jobs are going to come. Now we have this huge demographic so-called dividend. Unless we're able to give them jobs, and we've already heard a great deal about the jobless growth and the kind of social unrest also that it spills out into. So I think this perhaps is the biggest worry, that unless manufacturing picks up, we won't be able to give jobs not only to our youth, nor will we be able to remove the surplus labor in agriculture and improve productivity there. So that really is the biggest cause of concern. And I think here maybe the government needs to adopt a sectoral policy. It hasn't perhaps done enough in sectors like automobiles, telecom. So I think these are the sectors where perhaps jobs could be created. But would you agree with Saugata that the government perhaps need to have follow a sectoral approach in order to improve manufacturing? Saugata?
No, so I agree, Mythili, that probably I think the government has more or less done all that it could within the constraints of the fiscal space. And even though it is doing some coordinated moves with the Reserve Bank of India in trying to motivate credit. So a couple of points. One, of course, I mean, I don't think growth will revive very quickly, even if we have bottomed out in January without an infusion of credit in the system. I think the credit pipeline is completely clogged. I think that's the biggest worry. So this might be a supply or a demand problem. We believe it's both. So the companies that either they have the money and they are doing some investments with their own internal resources, or else they are unwilling to invest. As Madan was saying, I mean, despite with capacity utilization falling, it's difficult to induce firms to invest in this environment. So the two or three sectors, as you pointed out, one, of course, is credit to SMEs. I think needs to increase. I mean, I totally agree with you that we need to be able to figure out ways in which job creation can be incentivized, can be accelerated. So two or three sectors, with overlaps between the two. Construction being one, whether it comes in from infrastructure construction or real estate construction, and within this space, given the long tails and vendor chains, supply chains within these sectors, credit to MSMEs. So there are two things that I think need to be done. One, the government needs to find resources with which to clear the pending dues. I believe it's a significant amount. Hearsay has it that over 6-7 lakh crores, even more, is stuck in various stages with refunds, dues, credits, etc. for the government. So that is interfering with cash flows, and banks are not giving full working capital credit to this segment. So I think that needs to be looked at very, very closely and very, very, very quickly, how to get resources to clear some of those dues. And as you mentioned, maybe there needs to be some further slippage and spending to be able to move with that. And second, after that, the sectoral approaches that the government is spending, particularly the last mile funding, which hasn't taken off very well from what little I understand. So that and some of the infrastructure pipeline projects, I think those need to be done. So if you're saying that the focus needs to be private sector, it's not going to come in immediately. So I think the first thing that needs to be done is to figure out how to raise resources, monetizing government assets through sale of road assets, airport assets, etc., to quickly get some cash flows into the system so that the government itself can activate some part of the national infrastructure pipeline.
Akhil, would you agree that the problem really is not so much within the realm of monetary and fiscal policy, particularly as far as bank credit is concerned? Because if you accept that we are a bank-driven economy, unless bank credit picks up, you're not going to see a revival either in investment or in consumption, and certainly not in growth. And the solution there really lies outside. And I think the government has woken up to the problem, because we heard the finance minister at the Times Now summit talk about the various confidence-building measures that the government has initiated in order to ensure that bankers don't feel scared, do not have those fears about witch hunting. But do you think it's going to be a little difficult for bankers to completely believe what the government says, given what they've seen, what's happened to their colleagues? And that is really the problem, that the answer to increase bank credit lie outside the realm of either fiscal or monetary policy. Akhil?
See, those behavioral impediments, I think over a period of time, next 2-3 months with assurances of government can go away. The real issue, as you said, is, the private sector not investing and the banks not being able to lend. Now, there has been a coordinated effort by the government and RBI in form of fiscal policy and annexures to the monetary policy to push it, giving liquidity to the banks, sector-specific liquidity to the banks, giving some regulatory relief to the banks, is kind of forcing banks to invest. They eventually will lend, they eventually will push credit. Government on its front has obviously given relief, partial credit guarantees, and even outside the budget they had taken many policies and they continue to take. But I think a little bit more push, as we have already discussed on this panel, over specific sectors, especially I would feel construction, both in terms of infrastructure and real estate, needs a bigger push. And that is one sector which even the banks are as of now wary of lending, as we see the data. So I think that is where the real answer lies. That is one sector, one larger piece which both banks and the government have to sit together and work. RBI on its part has been doing quite a bit, even outside the realm of monetary policy. So it's work in progress, it's happening. A little bit more policy push is required towards a particular sector's construction, a little bit on the manufacturing side, so that can take it out. But as of now, as data comes, as we have all said, it's not a very encouraging picture.
Madan, so Saugata mentioned a sector which actually I forgot, that is the MSME sector, and that contributes hugely both to production and more importantly to jobs. And there both the government and the RBI have tried to incentivize lending to the MSMEs, give them some kind of forbearance, etc. But do you think this will move the needle, particularly given the fact that banks have had a rather unhappy experience with things like the Mudra loan? Madan.
No, I think you're right, because I think while there's been a lot of push being given to banks to lend more to the SME segment, we should remember that there's always a case of saying that we may be repeating the kind of mistake which we did earlier. Because if you go back to the genesis of the NPA problem, it was that time lending to large industry. Today we're saying we're lending, and then we went into this business of debt restructuring, then recognition of NPAs. Now I think it's the second time which we have done the same thing about for the SME loans, saying that we're not going to treat them as SMEs, we're going to restructure them and give them more time in order to recover. So I think we have to be very careful about these kind of measures where we are forcing banks to lend to these particular segments. And as you mentioned, the Mudra loans turning bad, that incidence has also increased. Similarly, if you also look at affordable housing, we have seen that at the lowest level, one of the earlier RBI studies showed that there are NPAs increasing out there. So I think in these kind of situations, one has to be careful about forcing the financial system to lend to certain segments which are not doing well. Otherwise, we could just be creating another NPA problem, maybe of a lower magnitude, but just at a time when we're getting out of one problem, we could be creating another one. And I think credit is just one part of the story. Finally, it all goes back to demand. We need to see large industry doing well. Only then will the SMEs see that kind of push for the demand for their products. So I think trying to fix these things by forcing banks to lend may not be the best of ideas.
Absolutely, Madan. As a former anchor, your words are music to my ears, but I'm afraid we've run out of time completely. So I'll have to thank Madan, Saugata and Akhil for joining me in discussion both on the CPI as well as the IIP. Not a very happy state of affairs, but I'm afraid we've been in this kind of a situation for quite a while now. It's becoming almost like business as usual. Thank you so much, and with that, it's back to you, Avan.